Good evening, ladies and gentlemen, and welcome to our company presentation. Our company members are CEO Chanel, Sarah, which is Head of Production, Daisy, which is Head of HR and Marketing, and myself, which I am Head of Finance. Our company is Andrews Limited. Over the course of the weekly rounds, Chanel and Sarah have worked together on the R&D and production departments. Daisy's has focused on marketing, and I've conducted the finance. Over the course of our presentation, we'll be discussing our mission, management principles and values, our strategy, how we implemented these, our company success measures, our performance over our rounds, going through year-to-year insights, collaboration, and our company vision moving forward. And at the end of our presentation, we'll discuss any questions that you may have. Now, our mission at the beginning of all this was to be an industry market leader, providing competitively priced sensors for the industry comprehensively. We commit to deliver solid value products, enabled through robust R&D, automated production capabilities to achieve cost optimization leadership. We had values of transparency. We pledged to value all our stakeholders and conduct honest business. We promised to deliver on our commitment to low-cost products to the benefit of our stakeholders. And sustainability. We promised to care for all our stakeholders and conduct our business in the most environmentally sustainable way possible. Now, our strategy. Our strategy from the beginning was to focus on being a broad, low-cost leader. We wanted to maintain presence in all of the markets. And with our marketing, we focused heavily on the low-end and traditional segments to boost awareness and to maximize profits, as these areas had the highest market share. Our strategy for production was to focus on reducing labour costs by increasing automation. And in finance, we intended to focus on the long-term bond issues and stock issues, and trying to keep finance to a minimum so that we didn't incur too many costs. Now, how we implemented our mission and strategy. In R&D, we focused on keeping up with the customer demands and needs and making adequate shifts while keeping our costs as low as possible, and we seem to have achieved these missions. In production, we increased automation early in the rounds, focusing heavily on the low-end and traditional markets, as these areas had the most product turnover, but raising automation across board. By raising this automation, we were able to keep our material and labour costs to the absolute minimum, which is all part of our strategy. In marketing, we focused on keeping prices as low as possible while still making sustainable profit. We had to ensure that our prices were competitive to maintain market share. We spent a substantial amount on marketing to ensure we had adequate market share, which was part of the initial marketing strategy. In finance, in the first few rounds, we had to invest in financing with predominantly long-term bond and stock issues to be able to maintain our decisions. But after the company started to make profits, we kept financing to a minimum to keep interest expenses to as low as possible to once again keep costs low. We kept all of our movements along the lines of our strategy, which seemed to enable us to be quite profitable, in which Chanel will now cover our key success measures.
Good evening, I'm Chanel Vuletic, the CEO of Andrews Company. I'm going to take you through our company success measures as well as our performance for the last 8 years. So as you can see, the measures of success were our market capitalisation, stock price and return on sales, each with a 20% weighting, and our minor success measures were profit margin, return on equity, return on assets, and market share at 10% each. We chose to have quite a large number of success measures to ensure that we were accountable and focused on company performance across many areas. We had to be careful in our product positioning and pricing, spending on marketing, our production facilities and automation, our contribution margins, as well as our spending on TQM initiatives to ensure that we could reduce our costs and overheads and improve our revision dates, as well as increase demand. On finance, we borrowed quite a bit initially, but we focused more on stock issues, and over the last few years we've had a lot of focus on paying back our debts, which you will see later on. As you'll see from the perceptual map, we really focused on having products in high-end performance and size right at the ideal position, if not in front. You can see here some of our competitors did not take this approach, and we have obviously outperformed them as a result. In the low-end and traditional segments, we focused on the age and the price that the customers were looking for, and less importance was placed on position as such. As I mentioned before, our revision dates were reduced significantly through our strategic spending on TQM initiatives. We also introduced a new product, Alba, which is our high-end product, and that enabled us to move some products across segments. So we moved our previous high-end product to traditional and moved our previous traditional product to low-end. So we've ended up with Acre and Able as our two low-end products, which gives us a strong presence in that segment. Our performance has been exceptionally good, and you will see our steady increase across the years. Return on sales has increased from 4.1% in 2014 to 14.4% today in 2022, a 350% increase. Our return on assets increased from 4.3% up to 17%, which is a 395% increase. Return on equity increased from 8.6% to 22.6%, which is a 263% increase. Our sales have increased from 101 million to 358 million in 8 years, a 354% increase. What is most impressive to us is our earnings before interest and tax have increased from just under 12 million to 88 million, which is a 736% increase. So how did we compare financially to other competitors in the industry? Quite well. As you'll see, on leveraging we are the lowest at 1.3, which confirms our commitment to repaying debt. We also have a credit rating of AA, which is the strongest in the industry. Our share price is currently $146.36, and our market capitalisation, 448 million. To give you an idea of how far we've come in 8 years, our share price has increased from $34.15 to what it is today, which is an increase of 428%. Our market capitalisation 8 years ago was 68 million. So we've had a massive increase of 659%. Profit this year was 51 million, almost $20 million higher than our next biggest competitor. I'll now pass you over to Daisy Vogels, our Head of Marketing, who will take you through our year-by-year insights.
Hello, my name is Daisy Vogels, Head of HR and Marketing, and I will now take you through the first 5 years of our company performance and discuss how our research influenced our company decisions. Sarah, Head of Production, will then take you through years 6 to 8. In year 1, our aim was to increase automation in low-end and traditional segments to ensure we could be a low-cost leader. We priced to the demands of each segment and spent most on marketing our low-end and traditional segments where we had made large investments in automation in order to quickly increase awareness and accessibility. We also financed using long-term debt to smooth out debt repayments. In year 2, we chose to issue shares to avoid further borrowings, which thus funded additional investment in automation, particularly in low-end and some in the traditional segment. Our focus was to reduce labour costs in these segments as early as possible so that we could keep our price low in the following years. We continued to produce very close to the sales amount and had few stockouts, unlike the previous year. Our marketing continued to focus on low-end and traditional segments where we spent less in other segments. This year saw us looking closer at the way we spend our marketing budget. From our research and the changes in the marketing landscape that have occurred over the last few years, we believe implementing a social media strategy is vital to gaining awareness in an increasingly online world. Consulting with Sumitra Dutta and her paper, What's Your Personal Social Media Strategy?, we have established that looking to social media for low-cost marketing solutions that will allow us to quickly and effectively engage with our customers and stakeholders will be key to our growth as a company. A social media strategy formulated by our marketing and public relations team will be implemented in the near future with a focus on LinkedIn. Year 3. With another large stock issue to fund investments, this round we stepped up automation in traditional and also in high-end and size segments. Previous years meant we were well placed in our low-end segment and making solid returns. We also increased capacity where needed. We suffered overproduction issues this year and had far too much unsold product, an issue we rectified in later years. This round we invested in a new product, Alba, which was our new high-end product. We chose to move our old high-end product into the traditional segment and our existing traditional product into the low-end segment. We felt we could maximise profits in the low-end and high-end segments by doing this, as we were rapidly losing market share with our existing high-end product as a result of poor positioning. With a strong low-end segment, another product would pick up further sales. In Year 4, we overproduced in our traditional segment. Our automation was increased in traditional, performance and high-end. Our new high-end product, Alba, was introduced towards the end of the year and stocked out. We also paid our first dividend to indicate to our shareholders that we were going to start paying profits out. This year saw us engaged in labour negotiations and evaluate our business principles. Ethical business is important to Andrews, and we believe it is important to look after our stakeholders. As stated in Stakeholder Theory and the Corporate Objective Revisited, Stakeholder Theory demands that values be central to doing business. Therefore, the Stakeholder Theory has been vital to how we manage one of our key stakeholders, our employees. We believe that when we look after our stakeholders, our profits will grow. Because ethical behaviour is fundamental to our business practice, it is important that we negotiate wages to find an appropriate balance between fair pay and ensuring labour strikes do not occur. In understanding more about ethical negotiation, our research led us to making decisions based on certain ethical criteria. As discussed in Ethics in Negotiation, Oil and Water or Good Lubrication, the authors discuss how ethical decisions are the result of multiple criteria analysis and look specifically at the Golden Rule, utilitarianism, universalism, and distributive justice as the most commonly used ethical criteria in business. As a result of our research, and applying these ethical criteria to our business solutions, we believe that we have made well-informed labour negotiations that is reflected in the outcomes of the last 8 years. Year 5. It took us a few years to transition our old high-end product and traditional product to their new segments, and our return on sales suffered as a result. We issued more shares to fund increases to production and repaid some current debts as well as long-term debt. This saw our credit rating go from CCC to A in 1 year. Automation was increased for size and traditional. We were now happy with automation levels across all of our segments.
Thank you, Daisy. In Year 6, we begin our focus on the high-tech segments and launch an aggressive marketing campaign to increase market share. As now, our low-tech products were well placed and making solid returns. Again, faced issue with our sales forecast. We underestimated and underproduced our low-tech segments, and this caused our product to stock out and impacted on our sales. On the other hand, we incur high inventory costs due to overestimated overproduce in the high-tech segments. However, despite this setback, Andrews continued to show strong numbers, and this we attribute to lower costs due to high level of automation and TQM initiatives. With our strong earnings, we paid a small dividend of 30 cents per share back to our shareholders. Ending 2020, the company made a net profit of around 20.5 million. In year 7, we continue to focus on the high-tech segments. We increase R&D expenditure to better position our high-tech products to meet customers' requirement. To further reduce labor costs, we increase another round of automation across the high-tech segments. This year, we failed to anticipate the increase in demand and stock out on both our low-end products, Able and Acre. We also incur a high carrying cost on Agip, our size product, as we were unable to sell more despite high customer ratings. This is due to late revision date. Once again, due to our successful reduction in labor and material costs, as well as increased demand through various TQM initiatives, we expanded our net profit margin to 10.12% from 8.73% in the previous year. Our company paid another round of dividends at $1.50 per share back to our shareholders and achieved a net profit of around 28 million. Our share price closed at $102.74. Credit rating agencies have noticed our positive change to our profitability and liquidity. Standard & Poor's upgraded Andrews credit rating to AA. In year 8, Andrews enjoyed another fantastic year. These strong results reflects Andrews' commitments to improve performance, strengthen the balance sheet, and deliver greater value for shareholders. We deliver strong margins expansion across most of our segments. The company continues to return cash to shareholders, and this year, Andrews paid back 10 million of long-term debts, repurchased 161,000 shares for 16.5 million, and declared 6.12 million in dividends. Our team delivered record revenues of 358 million, while generating 45 million in cash flows provided by operating activities. We made 50% more profit than what we have projected, and our share price increased to 146.36 with a change of 43.62. Going forward, we strongly recommend to the new management team to continue to focus on our company's mission, set clear strategies and direction, as well as staying relevant and responsive to market changes. Conduct thorough market research and closely study the CAPSIM handbook at the beginning of every year to improve our win rate. Further improvement in awareness and accessibility to increase market shares. Offer new product lines in the low end and high-end segments to increase dominance and presence. Continue with our ongoing cost discipline. By lowering operating costs, this can be achieved by increasing automation and TQM measures. These create solid foundations for growth and poised to deliver better results and additional value to our customers and shareholders. With this, we come to the end of our presentation this evening. On behalf of our management team, we thank you all for your support and confidence in Andrews. Thank you. We open now for questions.